Welcome to Listen to the Market for Thursday, February 9. The daily message using the L.I.V.E approach suggested that Wednesday was in fact going to be a top, hence Thursday would be a down day. The other message from Wednesday's analysis was that Thursday should present more trading opportunities than Wednesday did. Let's see how this panned out. The market opened pretty much unchanged on Thursday morning, and then came down to break below Wednesday's lows early in the day, about 11 o'clock my time. This presented the AA aggressive ambush concept approach to look for buys. The market rallied for 1 hour or 2 hours, and L.I.V.E students will recognize that the formation that was formed was in fact a FIP dip buying setup. The market then rallied, came back for a retest variation of that low, and then a secondary rally came to push the prices above Wednesday's highs. Again, having broken above Wednesday's highs, the aggressive ambush came into play, saying look for sell setups. And quite nicely, the hourly chart, 2 hours from the top, the bar here provided a retest variation sell, and the market then steadily declined to make lower lows and lower highs, bringing us to the current bar on the hourly chart. Suffice it to say that no forecasting technique is ever 100% accurate. So too with the application of the L.I.V.E rules and the L.I.V.E philosophy. Let's have a look at the campaign of the day in terms of the top-down approach. The hourly chart presented a fake-out buy. It also kicked in a particular application of the L.I.V.E setups, being an R setup, a reversal setup. This then said simply looking for a buying setup, buying opportunity on the smaller time frame. So we had two rules coming into play. We have the general L.I.V.E rules, being a fake out buy, and we have the R rule subset saying look for buys as well. The 30-minute chart was formerly a fake out second bar reversal as a buy, and our dear friend on the 15-minute time frame was an RTV surrogate buy, which means simply looking to buy above the high of this bar through there, with the initial stop loss at the low of the bar through there. The first 15-minute bar came along, we opened, made the lows first, got in the trend followers on the short side, a mini aggressive ambush came into play. On the 5-minute chart there was a nice reversal. The market then rallied, broke the highs of Wednesday, got us long. The initial stop had been adjusted from the low through there to the low before the entry point. By the end of the first 15-minute bar, the market had broken the previous day's highs yet again, and additionally the market provided about a 2-hour return as at the close of the first bar of the campaign. Second bar of the campaign sees the market continue to the rally, and that allowing you to lock in a 2-hour return before moving down. The 30-minute view by then was similar, whereby the market had rallied, broken Wednesday's highs, and retreated back into the middle of the range, saying this is potentially a top in the market. I'm not saying it's the top, but potentially a top. The next bar comes along, and had the stop been simply raised to the low of the black bar, on the 15-minute chart basis, one would have been stopped out for about a 1-hour return. By aggressively managing the long campaign, by acknowledging that the market had entered the AA rule set at the highs, looking for sells, one had ample time, ample warning to raise the stop to lock in about a 2-hour return for that campaign. As the saying goes, 2 hour a day keeps the doctor away. That's all for this time. Next time round. Bye.